Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Monday, October 30th. Hey, I apologize I couldn't do it on Friday. As I mentioned, I believe Thursday morning, I did go to a work event and it just kept us way too busy, so I had no time to create that for you. But Friday's market was basically dictated on rumors coming out that Trump seems to be favoring Jerome Powell as a Fed chair for next session coming in February. And there's kind of rumor between him and Taylor. Taylor seems a bit more hawkish, and not that Jerome Powell is a dove, but he's a little less hawkish than Taylor. And then also some strong earnings reports came out of the big technology sectors like Google and such. So good news overall there. Both bonds and stocks went up as a result, while yields declined. So let's kind of jump into this today and start our economic calendar. And we'll start off with the personal income for the month of September. So back in August, it went up 0.2%. Forecast was supposed to go 0.4%, and it came up rate expectation of 0.4%. So obviously people are making more money, which is obviously a good thing. We see, on the other hand, people spending. So consumer spending for the month of September. August was 0.1%, but September was supposed to go 0.9 and exceed that to 1%. So great numbers to see right there, especially coming into the holiday season. Then we get the inflation. This is the Fed's favorite gauge for inflation, the personal consumption expenditure, also known as the PCE, for the month of September. So we had a 0.2% for the month of August. We forecast to go 0.4%, and it did come in at forecast. So that basically goes up from 1.4 to 1.6% year over year for the headline number here. But the Fed really looks at more what they call the core PCE, and they also call this core inflation for the month of September. And this is where you strip out the food and energy that could create volatilities and big swings in the market. So this is really the number they look at. So August went at 0.1%. We forecast 0.1%, came in expectations. This remained unchanged at 1.3%, much lower than the Fed's target rate of 2%. So again, with these rate hikes, typically rate hikes are meant as a deterrent for inflation, fighting inflation, and we obviously are not seeing that, at least in the PCE index here. So again, this is something to be watching going forward, especially tomorrow when we have the Fed meeting tomorrow. The FOMC meets tomorrow for 2 days. They do not expect to raise rates at this meeting. They are expected to raise them, however, in December. But they're going to carefully listen to investors. Going to carefully listen to their announcement by 11:40. I believe it's by 11:15 Pacific Standard Time. They'll start really listening carefully to the headline that and look and review the notes of the Fed once it's released, or their statement wise. Headline news: stock market's down. A lot of things going up and down here today. We got we had some pretty strong data that came in here, and then one of the things that kind of brought up a little bit was the next Fed chair, Jerome Powell. But now all of a sudden you got something cooling. It's like you get a little spark, and then all of a sudden you get a little water thrown on it, or wet blanket thrown on it. So we get the Fed chair, which is good news, which will kind of help. But then you get the Russian probe coming in, and anything tied to Manafort. We probably heard that Manafort turned himself in. He was former campaign manager for the Trump administration, resulting to ties with I believe, Russia. So any ties to possibly linking to Trump, even though we don't think there, or we don't know if there is, but nothing seems to be out there showing that there's any ties to him directly that would potentially destroy or lose faith in any potential optimism for growth in businesses here. I mean, Trump is basically, you know, the optimism in the markets are due to Trump's vision of growing the economy, and anything that derails that, could sink the markets here. Corporate tax cuts. Taxes came out that the House of Reps basically are planning to, instead of just fully implementing right away, they're looking at gradually increasing it. So, which will reach the 20% by 2022, which is another 5 years. Which, it's less appealing to the stock market. They thought they would release this immediately, and now they're talking about this would be a gradual improvement, and of course that's not really fast enough for investors. Of course, we got earnings reports coming out today, um, and Then, of course, one of the things that's not really impacting it so far today, but of course, we got Spain with the Catalonian independence. Spain sent in and took over the government over there, and we had demonstrations over the weekend. About 300,000, I think I heard, for pro-unity. But again, they're talking about maybe elections again, looking for their independence. So that's something that's going to be, it looks like an ongoing saga. Of course, it's been going on for a long time. We don't hear as much about it here in the U.S., but it looks like we're hearing more about it because of the issues that are going on over there. And this is something that would, of course, such a large country in the EU, if something happened like this, obviously it's going to disrupt the markets over there. So let's see how this is playing on the bond market. Bond market's doing fantastic. We're up about 22 basis points. We're just up above this 200-day moving average, which is important because it can keep us down and make us drop further. If we can close above this and stay above this, including next couple of days, staying above this 200-day moving average, it'll give us a little bit more of a lift and we could potentially rise up. But this week we do got, again, a lot of important data coming out, and with more earnings reports and jobs numbers coming out later this week, that a lot of that volatility could disrupt the market, the bond market, and or even play in the favor of the stock market. Stock market's been pretty hot late, so obviously it's not going to stay down long. But we got this 50 to 25-day moving average coming down. At some point, it's going to become a tougher ceiling here once it starts hitting this first line of resistance. So we're touching up against this first line of resistance, but just above this 200-day moving average, which is a good sign. Rates do show improvement. So we had improvements on Friday, and it looks like it's continuing today in our pricing for our interest rates today. So on the flip side, we got the 10-year Treasury. It looks like it dipped on Friday, as you can see here. Basically, it took all the gains it had on Thursday and it dropped. And then today it continued that drop, and it's going down the first level of our floor support. So right now it's coming just under this first floor of support. We're right in the 2.337 range, dipping below the 240. So that's good news, obviously, for interest rates here. So that pretty much wraps it up here. I hope you guys have a wonderful day. But if you guys want to get more updates, just come over to Twitter. You can find me on my handle here at Mike Bjork under Twitter, and you get your updates throughout the day. Hope you guys have a wonderful day. Look forward to talking to you guys tomorrow. Again, apologize for the long one. Just kind of wrapped up, at least give you a little bit of Fridays as well as today. We had a lot of data to go over today. Again, hope you guys have a wonderful day. Thanks so much for watching. We'll look forward to see you tomorrow. Bye-bye.